Give us a sense of how you interpreted those employment numbers today. They seem to be strong pretty much across the board, but did it take into account the Delta variant?
Well, it was strong, and I certainly think it's important to look at the 3 months average. If you look at the 3-month average of adding 800,000 jobs a month, those are strong numbers and show continued strengthening of the labor market. That's the first thing. The second thing is it is true that a lot of the employment growth in July was what I would call in-person activities. It was leisure, retail, hospitality, people going to restaurants, people going out to personal services. What is a little unclear, and by the way, also education. What is a little unclear is what is the course of Delta going into the fall, and will that slow that momentum for those kinds of jobs and services down? And I think that's a legitimate question, and I'm not sure, we don't know the answer. Therefore, I think that's one of the reasons why the market is saying hard to interpret.
Oh, so let's go to the markets, actually, David. It's over to you here on what happened, because when I came in at 8:30 this morning and Friday morning and looked at the numbers, I thought, boy, these are great numbers. The markets are really going to go up. They didn't go up that much. It was mixed. In fact, the NASDAQ was down a little bit. Is that because, as Laura said, this is some doubts about Delta variant, or is it really fear that it may cause the Fed to increase rates sooner?
I don't really think it's either of those. I mean, the markets are very, very high. I mean, we've been going up for a very long time. We are, from these heights, it's hard to justify moving up quickly from here. But on the Delta variant, I mean, look, I know the virus is mutating, but you know what? In some ways, the economy is mutating also. I think it is really interesting that we had a huge crash in the economy last year, and then a rebound in the third quarter. But every quarter since then, we've grown. We're on our fourth wave of COVID here, but the economy is really adapting to it. So I do think the Delta variant will slow things down a little bit over the next month or two. I think hopefully it'll peak and come down again. But as I look at the economy, it looks like people are adapting to it. Yes, we're going to get much more serious about vaccine mandates. You want to work here, you got to have a vaccine. We're going to get more serious about wearing masks. But it's not going to stop people from reopening the schools or getting back to doing the things they want to do. We're just going to have to do them in a different way. But I've confidence. The virus mutates, but we mutate too. And I think the economy is actually going to keep on growing through this.
So Laura, back to you. What does that say to the Fed and monetary policy as a practical matter? Because I think what I just heard from David is we're learning to adapt to it. It's not going to be as robust as we thought. It'll be more tempered. But does that mean actually the Fed can be a bit more lenient with monetary policy longer?
So I think the Fed it was very clear. You had a comment from Vice Chair Clarida, but we also had a comment last week from Jerome Powell. And basically what they're saying is that right now, given the advanced guidance they continue to issue with a goal of maximum employment and a long-run target of inflation of 2% with some overshoot for some period of time, the conditions in the economy, I think, continue to indicate that meeting those conditions may occur sometime in 2022 or early 2023. I don't think there's any news here in this report which would suggest what the Fed has been saying. The Fed believes, and I believe, that most of the significant increase in inflation over the past few months has been the result of transitory factors. Those factors will die out, and we will end up with perhaps a somewhat higher inflation rate, over 2%, but not much. And that will be consistent with the Fed's guidance on what its policy is going to be.
So, David, does that mean the sky's the limit as far as equities are concerned? Because it seems like almost no matter what happens, equity markets just go up. How much of that is just supported by the Fed as opposed to fundamental underlying growth?
Well, I think a lot of it is. But of course, the Federal Reserve has been fueling asset price increases all over the place for years, really for a decade now. And my real concern is not so much the Fed is fueling inflation, but it's just causing asset prices to rise much faster than the economy overall. And that could cause asset bubbles or generalized asset bubbles. So I think the Federal Reserve needs to begin to normalize. I agree with Laura. I don't think that we're looking at hyperinflation or very high inflation. I think most of it's transitory, but we have seen big increases in asset prices. And I think what's going on is these very low interest rates are fueling a lot of nefarious things in the economy that we really don't want to see. Very high increases in home prices, a lot of speculative assets drawing money in. So I think the Federal Reserve really needs to think about normalizing, and they also have to think about timetables here. You're supposed to get ahead of this, not react late to it. So I'm worried that they're taking too much time getting to tapering and talking about raising interest rates from essentially zero levels in an economy which is really barreling towards full employment.
So, Larry, this is a really great point, I think, that David's making. I think everyone pretty much agrees sooner or later you have to taper. I mean, you have to do it at some point.
Yes,
the question is, when do you have to do it? So my question to you is, when should the Fed start to taper?
So can I first say that what David said is the Fed's forward guidance about rates never mentions asset price inflation. Okay, that is not part of their agenda. Their agenda is maximum employment and inflation, and not the asset price inflation is just not mentioned. Okay, so that's the first thing. The second thing is they keep looking at the long-term rates, the same rates that you had up on the screen a few minutes ago. Inflation expectations are very well anchored. Their own estimates, they use a whole bunch of different expectations of inflation measures, all anchored. They don't feel the need, based on their inflation projections and their employment projections, to do anything about it. So to say when is, for my mind, to say you've got to say, when does the economy signal to them something different that says, okay, now we've got to act? They don't see it right now in the data. They don't.
So, David, part of your job is to figure out what's coming around the corner. I mean, they don't see it right now, but sooner or later, most of us think it's going to happen. So what are you looking at to say, you know what, now we better get a little bit more nervous, a little more conservative?
Well, the thing I'm looking at is actually wage growth. I mean, and I'm glad to see wage growth, of course, but wages are growing very strongly right now. And what that suggests to me is, the Federal Reserve thinks that the NAIRU, the non-inflation accelerating rate of unemployment, is about 3.5%. So about 3.5% is about full employment. You can push it down there. I'm not so sure anymore. I think the economy is structurally changed enough that at this level of unemployment, 5.4% today, we are seeing accelerating wages. Now, it's good to see wages rise for low-wage workers, but again, there is a danger that just too much monetary and fiscal ease here will cause asset bubbles. And I realize that's not part of the Fed's official remit, but if you think about what's put us in the soup over the years, over the decades. I mean, back in the 1970s, yes, it was inflation, but since then, there's been one asset bubble after another, blowing up in our faces, putting us into recession. That's what we need to avoid. The Fed, I think, has a responsibility to try and avoid the kind of asset bubbles that burst and end up putting us in recession.
Laura, last word to you, as not just an economist, but an economist who's helped manage this economy overall. We heard NAIRU, we hear Phillips curve, things like that. Do those models still work? Because we have been through in this economy something we have never seen in history. We shut it down and we brought it back up. Are we confident those models still tell us where we are and where we're headed?
No, we are not confident. Economists were not confident. They were not confident going into the pandemic that the NAIRU and the predictable relationship, such as it was, between inflation and wage inflation was standard, or wage inflation, the unemployment rate, and price inflation. So no, we're not confident. The models are all over the place about this. The macro models are particularly bad. They're pretty good at output growth. They're pretty good at employment growth. They're not that good at inflation. They're not that good at interest rates. So I want to say there's a fair amount of uncertainty here. And the problem for the Fed and for all of us is, how do you measure, how do you assess maximum employment? If that's their goal, if that's the Fed's goal, how do we measure that? We've got to look at labor force participation rates, which are way low. We've got to look at employment to population rates, which look much better in this report. That was a sign of real strength. The unemployment rate itself, we've got to look at not just the aggregate one, but the unemployment rate by groups the Fed is looking at. So there's a lot of uncertainty here about wage price link. And I personally think that, look, the wage growth numbers, I certainly agree that it's good news to have stronger wage growth. Absolutely agree. The other thing to point out is that these numbers are not suggesting, if you kind of think about the possible productivity growth, they're not suggesting any significant change in the inflation outlook, because you take the nominal wage growth, you take the productivity growth, you get the real compensation growth, and you say, yeah, the economy can absorb that.